Hey guys, Trey Carter here. I want to bring you guys a interesting video that I saw Jim Cramer actually post on a CNBC. I say his CNBC, the CNBC actually YouTube channel. I want to go over with you guys because the idea is that are we in a actual frothy stock market right now? As in, should you be in a position right now that you are plowing money in, or should you be holding money back? Should you be building your actual cash reserves and try to get in the neighborhood of actually 30 to maybe 20% cash sitting on the side, waiting for a little bit of a pullback? I don't know. Let's find out.
Now, you wouldn't know it from the sedate action, the averages. Dow advancing 62 points, S&P edging down 0.04%, NASDAQ declining 0.25%. But this is starting to feel a little bit like a Kenny Loggins market. Yep, we're on, I'm going to say it, the highway to the danger zone. All right, overly dramatic, I know. But you know what? I watch froth. Okay, froth really matters to me. In a frothy market, stocks will have enormous rallies that are totally disconnected from the underlying fundamentals. You get enough of these moves, and you have to take something off the table. Because just like when you pour yourself a beer, the froth doesn't last.
There's definitely truth to what he's saying about if things are starting to get a little overboard as a whole with the market, you should pull a little bit off. Now, that actually depends, right? So someone in like my situation that I prefer to be an individual stock picker. We really do a lot of research on companies. We love the company. If we love the company and we like where it's going, we actually investing in that company. So one good example is Tesla. Tesla is a company we've owned for a little over 4.5, maybe flirting with 5 years. If I had to put money on it and it being verified, I'd say 4.5. I don't know. I feel like it's 5. Oh well. But that's a company that we love and that we believe that it's going to continue to go higher, not just with stock price, but with them executing what they have in their actual forefront future. Now, when you look at everything with the Biden administration, what they're looking at doing with obviously the electric vehicle market, renewable energy, Tesla, I think, is adequately positioned to be one of the winner take most. So when it talks about taking stuff actually off the table, is Tesla that? Well, it depends. You know, like at what part did you buy in? Where are you at with your cash? Because when he talks about taking stuff on the table, my perception is what percentage cash are you? Right now, the position that I'm in, which we're going to talk about at the end, what we're going to be doing, we have a little bit of cash, right? Around 5, maybe 4% cash, to where if we did actually have something happen in the market, we could take advantage of it, but it's not going to be as impactful as what it was last year when obviously we had everything shut down. Obviously, prices went in the pooper. Most stuff went down around 50 to 60%. There's a lot of good buying opportunity when it comes to the financial, when it comes to the actual market side. So just something to think about.
It's a sign that people are getting too greedy. Remember, I always have said it from 16 years now.
Remember, one of my favorite quotes that Warren Buffett talks about: when people get greedy, be fearful. When people are fearful, be greedy. Now, that just as a principle in itself is something that's good to hold in your head. That doesn't mean right now, as a people being greedy, that you should go and sell everything, right? Now, obviously, I don't get financial advice here because I'm not a financial advisor. This is just me sharing what I'm thinking right now about for myself. But this doesn't mean that, we go out and sell everything. It also doesn't mean, like, when everything's going bad, you buy everything under the sun too, right? But it's definitely something you take into account, you have in your head. You're like, okay, where am I at cash-wise right now? Am I in a trajectory with my cash flow that I can continue to build cash? Or do I need to take a little bit off the table? And where are we at? I don't know. Let's talk about that here in a minute.
Bulls make money, okay? Bears make money. But hogs, they get slaughtered. And right now, this market's starting to stink of pork. What's got me so peeved? Let's go over it. All right, first of all, is it really that hard? The SPACs, especially the celebrity SPACs. These supposedly can't-miss ideas are becoming embarrassing, frankly. Michael Semblas, the brilliant chairman of market investment strategy at J.P. Morgan, wrote a devastating critique of this group earlier this week about the economics of these special-purpose acquisition companies that you're all playing in. If you start a SPAC, you're golden. If you buy a SPAC as an insider, you'll do fine. But as it kicks down the road, the food chain, it turns less and less valuable. Aside from a few superstars like Virgin Galactic and Draft.
I will say he definitely has a point. You can also say the same, for argument's sake, you can say the same thing about any company, right? If you were an early investor in Tesla, obviously you have a better benefit than buying in them today. That doesn't mean Tesla isn't a good buying opportunity for some people, and you shouldn't buy it today. I will say that when it comes to the SPACs, he is bringing up a valid point and there are other channels you can listen to that do talk about this as well. But SPACs are starting to get a little goofy. I mean, really, when I'm looking at it, I'm a big fan of Chamath. I'm a really big fan and believer in what that guy does as an investor, just kind of like who he presents himself, who he is, at least who I perceive who he is. And SoFi is a company that I've actually talked about on this channel that I'm a very big fan of, that I think they have a really good business, and I think they have a really good trajectory, and it's something that I want to be a part of. You know what I mean? It's something that I want to have my money invested into so I can contribute to that and be a part of it. Plus, I'll be real with you, like, I love Robinhood, at least loved Robinhood, their operating system, but I wasn't a big fan of their security. If I need help with customer service, I ain't getting hold of anybody. Fidelity, their actual interface, a little rough, but their customer service is seriously the absolute best. With that being said, though, too, SoFi is a perfect middle ground. Interface is really good, customer service through the roof. Something to think about.
Public investors aren't getting particularly good returns already from these things, at least relative to other assets, and it's going to go bad. And those are the good SPACs. These SPACs merge with startups, allowing them to raise cash and come public without an IPO. But the best merchandise has already been snapped up. There are only so many great electric vehicle plays. The SPAC cycle is just like an IPO cycle that I always tell you about. The best ones come first to get you involved, and over time they get steadily worse, and then worse, and then worse. And I got to tell you, there's no break in sight. Like I told you last week, the whole SPAC complex feels like one big bad inside joke, where celebrities who've never really run a business in their lives are pulling down big bucks, hunting for some takeover targets that will keep the frothometer spinning. Today I heard about a SPAC for flying cars. Hey guys, pigs can fly too. Second sign of froth? Cannabis. All right, here we go again. Didn't we watch this overhyped industry blow up once already? Sure, it could potentially be legalized. Maybe the financial regulations will get less punishing. It'd be more credit, less cash. But none of that's a sure thing. And these stocks have become ridiculously valued overnight. I have been right. I still believe in Canopy growth, though only because it has a terrific parent in Constellation Brands. And it can make great taste, no-filling cannabis drinks at scale like none of the other companies.
I'll tell you one company he doesn't talk about much of is Planet 13 as well, because they already have established brands that they've made themselves that sell very well. I'm not speaking from experience of actually using these. It's worth something to look into as things become more decriminalized. I'm telling you, man, out of any company that's set up, this company is set up really well. They actually make money on the balance sheet. They've raised adequate cash. They're ready for a storm. They've already shown last year that they actually could do a really good job in adapting in environments like this, especially through their delivery. The wait times there are insane. The demand through the roof. Something interesting to think about. He is bringing up an interesting and pretty good point, though.
Plays are destined to be nobodies. But it doesn't matter right now because they're all connected by the same ETFs, and they're all heavily shorted, and it's just one after another flying crazy. And that's part of what is the next cohort that I don't like, the short squeeze stocks. The ones that get pushed out because we've got a whole new, exciting generation, of marauders out there looking for any stock with a high short interest, even if it's part of an arbitrage spread, meaning it's not even going to work. The pot stocks qualify for this treatment, too. If they can turn into a meme, then they think they can take it to the moon. Yes, it's novel. It's interesting. Except for I've seen it a lot, and it's not novel. It goes bad. What's causing the froth? I could blame the Fed. Everyone wants to do that, right? Or the free money we're expecting from the stimulus, another blame. Or the excitement about reopening once everyone's vaccinated. And that is a big deal. Since I did get vaccinated today, I want to thank the great people of Staten Island for allowing me to get vaccinated. The truth is, it doesn't matter why it's happening. I just want you to acknowledge that some parts of this market are at truly insane, absurd levels. Because I wouldn't be doing my job if I didn't point this stuff out. And I didn't want to do this piece. This is a really great day. And I didn't want to stand here and tell you, you know what, I'm getting nervous. So what do you got to do about it? Well, first you got to understand, we've had nearly 11 months of incredible gains. And nobody wants to leave the tables when they're this hot. Nobody wants to hear some old codger like me tell you that profits don't count until you ring the register. I know you don't want to hear it. Or that these kinds of returns are an anomaly. You don't want to hear that. The kind of thing that sucks you in and never lets you go because it's so darn intoxicating. You don't want to leave because it's the money tree and you want to climb it and you don't want you pulling down it. You don't want me yanking you from the money tree. Already I can practically hear some of you saying, he wants me to leave? He's got all kinds of money himself, that guy? And he wants me to cash out? What's his angle? All right, listen, there's no angle. I've been in this game for 40 years. I've seen this before. Whenever we give them these red-hot periods, they're impossible to resist, and they always last longer than any of the grizzled veterans thought possible. I think it's going to keep going on, but eventually it does end, and you got to be ready. You know why so many people lost money in the dot-com collapse 20 years ago and then never came back? Because there was new merchandise created every day that was sizzling and exciting, and it went up almost automatically. Because there were companies with no earnings or sales, just eyeballs. I used to call them the ophthalmological wonders, because a huge part of that market had divorced itself from the fundamentals.
Something interesting to point out as well, I do agree actually with Jim, because over the last little bit, everybody and their mother is an investor. That, for whatever reason, has stuck with me. When you think about 2008, 2009, one thing my dad always talked to me about, because he was heavily involved during that time period, is that like it went from a moment of things are normal to everybody all of a sudden is in real estate. Everybody owns multiple houses. Everybody's involved in the stock market. Like, everybody is talking about it. Now when you get on Facebook, what's everybody talking about? They're always posting their Robinhood returns. What are they investing in? What penny stocks are really good to invest in today? If you get really bored, you really want to see it, get into some of these Facebook groups that talk about the actual market. It'll be a little eye-opening to you. A lot of people pushing penny stocks. A lot of people asking, what's the next big one that's going to be the next big jump? What's the next GameStop? It's not really investing related. It's all casino gambling related. This doesn't make me think I need to go out and sell everything. But I have been thinking about this, and this does like a little bit of affirmation for me that building some cash at this time is actually a pretty good idea. So getting from 5% to working your way up to 15, taking your time, having some money up to the side. If we get buying opportunities for things, listen, like, I'm not going to not take advantage of it. If somehow Tesla goes below $750, I'm going to nibble some of it. Guaranteed. Like, it's going to be going in. Even though pre-split, we bought at 360, we bought after the 420 tweet at around 179, I think is the lowest that we bought in at, which is almost like something I want to put on my wall, but that's pre-split, right? That's pre it being, divided up. But building some cash right now is actually, I think, a pretty darn good idea.
No fundamentals to begin with. At the height of the dot-com period, we're talking here between 1999 and 2000, 330 companies came public, and only a handful of them managed to survive. I know. I started a survivor company during that period. I was stunned that something like 97% of my colleagues who did companies then failed for stuff that was loved just a few months before. So you got to be careful when it gets this frothy. But, and this is crucial, I am not saying get out now. I am not saying sell everything. I am simply begging you to exercise some discipline and sell something, because nobody ever got hurt taking a profit. I don't want you to sell everything because, first of all, it's an excellent setup, as they like to say.
The biggest thing you got to think about, too, is that when you do sell, you've got taxes you got to think about. You just do. Something to think about.
The unemployment rate is way too high, and COVID's still out of control, even if the numbers are coming down, and we're doing much better with the vaccine rollout. However, those negatives are the reasons why the Federal Reserve won't raise interest rates. That means both the Fed and the tape, the action, are on the side of the bulls. It's not even worth fighting yet. I'm just trying to say that you're not a genius if you've made 50% in a month or a week or even a day. You're simply participating in one nutty, unsustainable moment of a part of this stock market. It's not you, people. It's the beast that's making the money, which is why you got to take something off the table. Second, just like in 2000, there's a whole other market that's not reasonably, let's say there's a whole other market that's actually reasonably valued. Let's do that. I'm not always going to say cheap, but it's good. When I was getting my second shot today in a tent in Staten Island, fabulous operations leader spotted that it was my birthday. The staff broke out with spontaneous, rousing happy birthday song. The tears of happiness were this close. They were this close. They're about to flow. So the guy behind me goes, "Hey, Kramer, I never miss you. What do you think of Merck?" I said, "I don't know, Merck. It sells 12 times earnings, doesn't have a lot of growth, 3.5% yield." And I said, he says, "But you want me to stick with the J&J?" I said, "No, I like the J&J, but how about the Bristol Myers? 8 times earnings, 3.3 yield." He said, "I don't know." I said, "Well, how about Walmart? Getting Henry Walmart." Got his app out. He says, "Yeah, I got to get some Walmart." You know what? That's okay. That's still a good conversation. It's reassuring when people ask me about steady Eddie drug companies and not the froth that it hasn't gotten too insane. That's a good conversation. But when they tap me and say, "Hey, Kramer, how about the flying car stocks? How about space tourism?" We're getting out. The reasonable market is still in charge right now. But sooner or later, at that pace, it's going to change too. Bottom line. Yes, you have to make hay when the sun shines. I want you to do that. Just remember, stocks ultimately are pieces of paper. and Wall Street will keep printing out those pieces of paper until the buyers run out of buying power, at which point the buyers will be steamrolled. We are not there yet. We are not. But if there's one takeaway from the frothometer, we are most certainly headed in that direction.
He's not wrong. It's going to be really interesting to see what happens over the next little bit. In fact, like, I'm really curious to see what you guys think, because I feel like I've been feeling like I've been a little bit crazy over the last couple weeks. But, you know, after seeing some people that I really listen to and I really look up to, not necessarily just pointing at Jim, but Jim is a guy that is a really big voice out there, especially speaks to retail investors like ourselves. That actually brought this up, but some people I really listen to and I really like, for example, like Jeremy over the Financial Education Channel, talking about SPACs, kind of where things are laying out right now. It's making me think it's time to raise a little bit of cash, be smart, take advantage of like where little off things happen. But it's time to build some cash, because I'm gonna be honest with you, like he's talking about taking cash off the table as in selling stock. I don't know how hip I am to actually selling our shares in Tesla, selling any of our shares really more in Planet 13 or some of these other companies that we own. That would be smart to do, because I'm not looking to pay taxes. I'd rather put more cash aside and have it ready for a rainy day or when things do pull back. Because listen, if you're thinking short term, yeah, you need to sell and pull things off the table. But my unrealized gains or my realized gains later on, I really care about those in the next 5 to 10 years. Not necessarily what it looks like next year or the year after, 2 years from now, you know? Something to think about, guys. Anyways, this is 1,000 Ways to Skin a Cat. I'm not saying this is the best way for you guys. I'm just telling you how I do it, what I'm thinking right now. It's kind of like a stream of consciousness, like Dave Lee always talks about, as in like my mind can and will change. But I'm curious to see what you guys think. Let me know in the comments below. Make sure you subscribe to this channel. And don't forget to smash that like button. I'll catch you guys in the next one. I don't know if you guys can tell, having a little bit of allergies. Got me some new glasses. Obviously, let me know what you guys think about these glasses, and I'll catch you guys in the next one. Peace.